again and welcome back to another session of commerce class with me Suman Rathore. Students, in our previous video we have already covered the straight line method of depreciation. Now today we'll understand how to prepare a set account while following written down value method or the diminishing value method of depreciation. And for this I'm taking this question from Arya Publications Goel and Goel, chapter Depreciation, practical question number 17. But yes, before moving ahead, let's revise the important points of depreciation. So first is, under straight line method, amount of depreciation remains same as we have discussed in our previous video also. And depreciation is calculated on the cost of asset. Okay? And this cost of asset includes all kinds of expenses that are incurred for making the machine or the asset useful for the business, like its erection, its installation, its carriage, etc. And under written down value method, amount of depreciation changes every year. It just keeps on decreasing every year. And depreciation is calculated on the written down value of the asset or the diminishing value of the asset. And again, for better understanding of these 2 points, you can check my previous video where I have explained these concepts elaborately. Okay, now third is, when the rate of depreciation is given with the word per annum. Okay, now pay attention here, it is very important. Like if the rate of depreciation is given as like 10% P.A or per annum, then depreciation is charged for the exact number of months for which the asset was owned by the business. So here the date of acquisition or purchase of asset is very important. But if the date of purchase of asset is not given, then obviously depreciation will be charged for the full year. And fourth is, when the rate of depreciation is given without the words per annum, like it is given simply as 10%. In that case, depreciation will be charged for the full year. Okay? Okay, now, so let's start our today's question. So it is given that a company purchased a machinery for rupees 50,000 on 1st October 2017. Another machinery costing rupees 10,000 was purchased on 1st December 2018. On 31st March 2020, the machinery purchased in 2017 was sold at a loss of 5,000. The company charges depreciation at the rate of 15% per annum on diminishing balance method. Accounts are closed on 31st March every year. So here, this is a pro forma of a machinery account, and here also asset account is prepared in the same way like the straight line method. The only difference here is that in straight line method, amount of depreciation was same every year. But here, amount of depreciation will change every year with the diminishing balance of the machinery. Okay, so let's start it. So on 1st October 2017, in the date column, write the year first, 2017. Then 1st October, a machinery was purchased for rupees 50,000 to bank account, because the general entry of this transaction will be machinery account to bank account, right? So this is our first machinery. So let's mark it 1. To bank rupees 50,000, right? Now on this machinery, depreciation will be provided. Here for depreciation, the word per annum is used. So depreciation will be calculated for the exact number of months for which the machinery was with the business. So here 15% of 50,000 comes to 7,500, right? But this is full year's depreciation, but we have to provide depreciation for 6 months only. So 7,500 into 6 by 12 comes to 3,750. So this is our depreciation on this machinery for 6 months, right? Now here on the credit side, in the date column, write the date first. It's 2018 March 31st, and entry will be by depreciation machinery 1 For 6 months, 3750. Now the closing balance of this machinery will be by balance CD carried down 46 to 50. Now this closing balance will become the opening balance of the next year, right? So we will transfer that amount here on the debit side to balance brought down. Year is 2018, April 1st, and amount is 46250, right? Now depreciation will be provided on this first machinery at the rate of 15% for the full year this time, right? So the year now here is 2019, March 31st, by depreciation machinery 1. Now 15% of 46,250 comes to 6938. Okay. Now it says that on 1st December 2018, another machinery was purchased for rupees 10,000. So let's make the entry of that machinery. December 1st to bank. This is our machinery 2. Amount is 10,000. Now on this machinery, depreciation will be provided for 4 months from 1st December to 31st March. So 10,000 into 15% comes to 1500, and 4 months comes to 500. So depreciation on this machinery for 4 months at the rate of 15% will come to 500. Entry will be by depreciation machinery 2 and date is 31st March. Now again we have to take the closing balances of these machineries. So March 31st by balance carried down of machinery 1, 46,250 minus 6,938 comes to 39,312, right? And 10,000 minus 500 will come to 9,500. So these are the closing balances of these machinery, which will become the opening balances of the machineries in the next year. So here is 2020 and date is April 1st. To balance brought down machinery 1, to balance brought down machinery 2. 56 to 50, 56 to 50 here. Now 39,312 and 9,500. Okay. Now it says that in 31st March 2020, the machinery purchased in 2017, this machinery was sold at a loss of 5,000. Okay. So now first of all, let's just provide depreciation, because full year's depreciation will be provided on this machinery this year also, because the date of sale of machinery is 31st March. So full year's depreciation will be provided. So 39,312's 15% comes to 5,897. Now for rest of the amounts, let's just understand the working note. Okay, now for this, let's understand the working notes. So value of machinery on 1st April 2019 was 39,312, right? And on this amount, depreciation will be provided for the full year, because machinery was sold on 31st March 2020. So depreciation for the full year will be provided on this. So 15% of this 39,312 comes to 5,897, right? Now value of machinery On 31st March 2020, the date of sale of machinery comes to 33,415, right? And now this is clearly given in the question that machinery was sold at a loss of 5,000. So that 5,000 will be deducted from this amount to calculate or to know the sales price of the machinery. So the sale price of the machinery is 28,415, right? So this is the sale price of machinery, right? Now let's put all these amount in our account. So now March 31st, sale proceeds of the machinery will be entered as by bank and the amount was 28,415, right? That's what we have calculated there in the working note. And the loss on sale of machinery as clearly given will be transferred to P&L account. So it is 5,000 as given in the question. Now let's talk about our second machinery. So full year's depreciation will be provided on this machinery this time at the rate of 15%. So the amount will be by depreciation machinery 2 and the amount 15% of 9,500 will come to 1425, right? Now let's take the balances now. Now our first machinery's account is closed because we have already sold that machinery. So we'll take the closing balance of our second machinery only. By balance carried down, 9,500 minus 1425 comes to 8075, right? Now let's just close the account because we have to prepare this machinery account for 3 years only as per given in the question. So the amount is 48,812 this side and 48,812 this side. So this is how we prepare machinery account by following diminishing value method. That's all for today, and in our next session we'll understand how to maintain accounts when provision for depreciation account is maintained. Until then, keep practicing and don't forget to like and subscribe my channel. Thank you and goodbye for now.